Thanks very much for joining us. Really interesting session that we've got today, looking at the global outlook as we come after the summer and we're heading into the autumn, and also a look towards what to expect, I guess, for markets in 2023. Obviously, really interesting time in terms of economics, but also geopolitics. And it'll be interesting to see how the panel view that in terms of the real estate and real asset markets. We're going to start with a brief introduction from Thomas. Thomas, of course, you're global head of real estate at PwC. Just, I suppose, give us a sense of where you're seeing the market at the moment, and then we'll discuss those in the panel.
Yeah, thanks, Richard, for inviting me to the panel. And yeah, I will give a quick overview, some fruitful thoughts on the market sentiments we hear in Europe, but we will challenge and combine that with the US view, and but also with the investors' view. So what the clients are currently telling us, that we are living in a world of volatility and uncertainty. We haven't seen that type of volatility over the last 10 to 20 years. What does it mean? We see high inflations in Europe above 10%. We have never seen that in the last 15 years. That triggers also significant increases in interest rates over the last months. Pretty volatile. We've seen some decreases, some increases over the last months, but significantly at the end, net, it's an increase in interest rate, which hits our business plans hardly, because we are an asset-heavy industry and we always use leverage. The general economic outlook was also mentioned, pan-European, as a topic that brings a lot of uncertainty, that we do not know what will happen over the next 5 to 10 years with the general economy. Also with Asia-Pac, what's the impact, what's the Americas impact on the European economy. Of course, we see a significant increase in energy prices. We see a significant increase in construction costs and supply chain disruption. We have already seen that last year, but it was an extreme fostering since the Ukraine war, so that's a big impact. And in the midterm, that's the current situation. In the midterm, of course, we see what does it mean from a geopolitical point of view, where's the shift going, to west, to east, what will happen, and also what's the impact on capital flows. And of course, in the mid to long run, we still have the big impact overlaying everything. It's a climate change and the climate crisis we are in. We are still discussing the Paris path of 1.5 degrees increase, but the IPCC clearly stated that this is nearly impossible now. So we have more to transform. How can we capture carbon? Of course, we have to still transform our stock. We have to reduce carbon emission, but we also have to think how can we reduce existing carbon out of the existing air. And the big long-term impact is what will happen with the people. We are all facing, would all love to hire more people, but the impact is there's a significant behavior change in the market. Everyone is discussing how do we want to work in future, how do we want to live in future, how do we want to shop. And that impacts, of course, directly our workforce in real estate, but also the asset types. Yeah? And that's something where we also see significant discussions, and we will see more and more changes over the next decade, I'm pretty sure. And of course, the current market is pretty quiet. I have the current number from Germany. Transaction volumes reduced by 40% over the last quarter. Compared to the last year. There's a flight for quality. It was always in the last cycles. If there is an uncertainty in the market, people try to invest in the most secure, what they think is the most secure asset type. But that's something we can also discuss. And we also hear from the interviews that the ESG impact on valuation, which was more a discussion topic in the past, will have a significant impact over the last 12 to 18 months. So that's really something that gets in place. We are all coming from a summer with extreme heats, weeks of no rain in Europe. So we see more and more extreme situations. And on the other, if we invest into real estate, financing is getting more and more triggered, driven by this uncertainty. Banks are more reluctant. Developers are really struggling to get their financing, especially on the higher LTV side. That's something. But the good news is, if we look at the global allocation to real estate, it's still at a high level. That's good. So nobody is moving away capital from real estate because it's not seen, it's strategically seen as an investment class. But of course, the competition around risk return profile is seen differently from risk managers, also from investment managers. So that's the topics we have seen in the, let's say, in the current market situation. And then we also asked our clients, what do you see for the next 5 to or potentially 20 years? And the clear message for most of them was, it's about ESG. We focused on energy efficiency in the past. We have to more and more focus on embodied carbon, on climate adaptation. As I said, we have to adapt our assets, and biodiversity is coming up for real estate as a topic we have to focus more and more on. Digitization is a big topic because also ESG is something that's fostering and moving digitization to the next level because we need data and we haven't done that in the past. We are the least digitized industry compared to other industries. Banking, insurance, they are much more digitized because the pressure was much harder to do something to improve operational efficiency. That's coming up now also for our industry. And of course, a discussion about what's the best use concept for my location, for my current asset, driven by the new normal of work, life, shopping. So these were more or less the topics we heard from our clients, consolidated. Happy to hear the same from the US, but that was my quick overview.
Well, go ahead.
Yeah, you do.
No, I'll just say quickly, I think it's one of the most exciting times to be in the industry because of everything you said. I think everything is up in the air right now, and it's all inside a context of increased risk and regulation, figuring out how to discern between relevant real estate and irrelevant real estate that needs to be either redeveloped or demolished. Our friends at CBRE are leading the charge as one of the world's largest investment managers in the space, and I don't see your investment activity slowing down, but you're probably tightening your underwriting and making sharper decisions as a result of, you said you're focusing on logistics. You know, the darlings of the industry right now relate to housing and distribution as we seek to come out of the pandemic and deal with the still disrupted supply chain, and that's done through our logistics industries. But I think it's also interesting that our industry is being called upon to solve a host of social issues. We know that in times of inflation, people flock to real assets because they want something they can invest in that they can see, touch, and feel. And so I think allocations for investment, but for the denominator effect of lost value in equities, has most investment managers increasing their allocations to real estate. The question right now as we sit in Brussels is, and as we prepare for Expo Real, is how much of that will be in Europe, how much will be in Asia, how much will be in the US. And I think as we look at that opportunity amidst the geopolitical uncertainty that we have, we also find our industry in the middle of discussions around solutions for major social problems related to infrastructure, transit, housing affordability, workforce housing, rethinking our built environment, all inside this discussion of ESG. As such, we find ourselves very busy helping clients decide how to navigate those issues, because it is a absolutely not only volatile, interesting time, but we're all faced every day with how we use space in our homes, how we use space in our office environments, whether our people will ever come back to the office. If they do, what will they see? I was in an interesting interview with one of the largest office landlords last week, and he said the loading dock on our building looks like a furniture store. As we watch people take out their cubicles and bring sofas and chairs and create living rooms in the office. Now, why is that? If you go to our London office, it looks like a multi-story Starbucks. And it is because we need our office spaces to be spaces not to have head-down work anymore, because we've been very productive doing that at home. It's got to be a place where we gather, where we learn, where we mentor. We are allowing a generation beneath us to lose the opportunity of learning at the coffee machine, learning walking down the hall, standing in line for food in the office, taking a walk down the block to have a meal together. Those things are offering a huge impediment to their personal and professional growth that requires we be together. And so I think in the context of everything else we talked about, Thomas, those emotional, mental health, socialization, and relational issues have also fallen on the shoulders of the real estate industry to solve.
And Pete, it'd be interesting to get your perspective as well, because obviously, as well as sort of EMEA transactions in terms of logistics, so you've got that view. You've also been country manager here in Belgium for the last 5 years. So it'd be good to get, I suppose, your sense of how you're seeing some of the trends there that both Thomas and Byron have mentioned.
I think we at CBRE we fully underwrite the same priority list like Thomas says, and those are of course very interesting because next to the financial and economical problems that we will be facing, we see a clear shift in our occupiers market, being it logistics. The entire way logistics are being handled is changing. Byron mentioned work from home, work from the office, so there the mentality is changing. Also retail, e-commerce, physical retail, so we clearly have to understand far more than in the previous years also our occupiers, and so that makes that real estate is less a financial driven product and needs financial underwriting, but also need a very clear understanding of your occupiers, your tenants, but not only stopping at your tenants, but also looking at the clients of your tenants. So that's a special focus for us going forward, trying to understand the big changes happening.
Okay, good. And Thomas, I thought it might be interesting. I mean, because obviously you do the global trends each year. Are there kind of big changes that you're seeing, particularly, I mean, we've looked a little bit at what's coming up. But I mean, if you compare that to, say, a year ago, when there wasn't the war in Ukraine, geopolitics seemed quite complex then, but by golly, they're more complicated now. So I suppose, how are you seeing that? And did that change the views of any of the sort of investors that you were talking to?
It's a significant change. It's a completely different world, as also Byron said. We have never seen an inflation above 10%. We have never seen such levels of energy costs. Yeah, a while ago I had an interview said, look, the market cannot solve the CO2 emission because the price of CO2 is too low. Now with the new energy prices, we have a significant market impact on the energy price. So there is a market-driven incentive to reduce CO2 emission. But that's a complete change. As I said, the construction the construction costs were already increased last year, but this significant push in 2022 hit a lot of developers pretty hard. A lot of projects are just stopped because they cannot deliver the project at a cost level which makes sense at the price level where I can sell the asset later on. So it's a completely different world now, yeah? With all the uncertainties we've seen. As I said, inflation, increased interest rates, we don't really know what the users will do. That's something we had last year. There was a discussion, but it was sharpened. And in the context that I do not really know where should I invest. This uncertainty is something I've never seen in my career.
And Byron, it'd be interesting to just get your sense, I suppose, of the good thing is that we're recording this, so I can edit that bit out, which is great. But Byron, it might be interesting just to get your sense of, particularly the US capital, I guess, and how they're seeing Europe at the moment, because there's also extreme things happening in terms of exchange rates.
Well, I think that the view of U.S. investors that have a proclivity toward investing in Europe, they see, because of exchange rates, the continent on sale. And so I'm working a couple of M&A deals right now in that regard, because the price all of a sudden became, at the time, more affordable because of the exchange rate. I think, though, the bigger concern in Europe right now is the geopolitical issues associated with energy and leadership. And so, whereas asset values for good assets in Germany will hold their value, I believe, I think there's real concern about the regulatory and leadership environment across many of the countries in Europe. And that's going to have to be, there needs to be a new measure of confidence, if you will, across the EU, especially in their response to what's happening in the Ukraine. And I think we're seeing the NATO allies come together and work very hard with their sanctions. But the real question is, are those sanctions working? And are those sanctions working in light of the ESG issues that are put forth? Because it's using the old kind of energy, some of which is being bought on the black market, as we know, and that's not healthy. So I think there's some systemic issues that are needing to be dealt with, and God knows we have systemic issues in the U.S. that need to be dealt with as well.
And do you think that means that there's going to be, more investors, more investment capital is going to be on hold waiting for those solutions? Or do you think that, actually they're still going to continue with their plans?
That's an excellent question. As you all know, we publish the Emerging Trends in Real Estate magazine every fall in concert with the Urban Land Institute. So Thomas and I are fresh off of literally 45 days of intensive interviews with the C-suite around the world. And it falls in the interviews I've been a part of into two very distinctive camps. One that is sitting on their hands and waiting, as you suggested, and then those that are seeking opportunities. There is more dry powder going into this recession than we've ever seen in real estate investment history. In the U.S. alone, over $400 billion of capital looking for homes. Pete, you all have an enormous amount of capital to invest,
Yep.
and you're charged with growing your assets under management, so you're not stopping. And most investment managers are not stopping, but the world seems to be divided. The developers have had to stop because many of their developments don't underwrite at current interest costs. But the investment managers are looking to take advantage of some of the buying opportunities as a result of debt that's coming due, securitizations that may show some weakness in their pools, assets that need to transact because of death or succession or estate issues. And so the opportunistic and value add capital is very active right now looking for those deals.
Okay, good. And Pete, I suppose from your perspective, obviously funds still being raised, logistics funds still being raised. Are people being more, I suppose, fussy about the types of assets they're looking for, particularly in that logistics market? Are there kind of concerns around, I'm not just going to buy anything. I'm now going to be much more kind of focused on which assets are going to return, and is it all around sustainability? What's the strategy that you're following there?
Well, for sure, it's no longer about cash flows. It's about income, and it's about sustainable income. So the income needs to be sustainable. What we believe is sustainable income is, of course, a strong covenant for our tenants, with an upcoming recession more important than ever. But it's also sustainable from an ESG point of view. We also see that in the logistics space, more and more occupiers are demanding that sustainability because their clients are asking it from them. So the winners in the 3PL sector will also be those who have the best sustainable policies and hence the best sustainable buildings. That's from an occupier point of view. And then I think in the wider ESG discussion, logistics buildings have one huge advantage over all asset classes, and that's their big roof. Because ESG in building solar, it's indeed solar, which is very difficult to implement on a office tower, but it's of course far more easier on a big logistics asset. And so I think a logistic asset has it in itself to be carbon neutral over the lifetime of the assets, which is very scarce in amongst other asset classes. And that will, I think, to me, will also give the allocation for real estate portfolios even more to logistics, because if portfolios need to be carbon neutral, it's very handsome or handy to have a carbon eating asset in your portfolio.
Most of these panels always point to the fact that we're looking for heads, beds, meds, and sheds. right?
Yeah, and one perhaps comment, Richard, is the big picture is pretty positive. Yeah, there's, as Byron said, a big pot of capital, and there on the other side, on the asset side, there's a big pot of assets that need to be refurbished, recycled, whatever. So the capital is needed, and the capital is there. It's just a question of timing, yeah, and the smartest solution around that.
And let's pick up that point around transformation, because there's a huge amount of work to be done quite plainly there, and especially if you look at Europe, where huge amounts of it were built a very long time ago. So most of the stock there is older. Is there a sense that there is now going to be a bigger focus on that transformation, both in terms of the financing side, but also the investment side? I mean, Byron mentioned there that suddenly the real estate market is expected to be doing all of these things, but obviously that's going to require investment capital to be able to do that, really. Is there that sort of depth of capital looking to come into that area?
Definitely, we see more and more funds in continental Europe focusing on this managed to green, or however you want to call it, because 90% of the stock exists. It's there. We only have smaller pieces here and there where we really do new developments in the market. So that's the key focus. But it all comes down to the right opportunity, to the right team, to the right solution, to the smartest ideas. How can I recycle this building, not only from an energy efficiency point of view, but also from the use type? What's the best use for this concept? And then sometimes we see some quarters developing. A good story, I think one of the largest globally, is like this NEOM project in the Middle East. Yeah, it's desert, and now from the scratch you have to think about what's the most sustainable from a use type solution, and how do I construct this piece of work? This is something we don't have in Europe. Perhaps Paris is doing significant large developments over the next 10 to 20 years. Grand Paris is a big thing. But usually in continental Europe, it's a nitty-gritty piece of work where you have to transform each of these pieces, and there's a lot of capital focus on it. But it takes some time because you need the right teams, you need to have the right ideas, the smartest ideas. But that's definitely a big focus currently.
I would say that we have to rethink our built environment, and some countries are doing a better job than others. But the response of more concrete and more steel is the wrong answer. And 80% of our office stock in the US was built in the 80s or before. And it's a time of looking at every building to determine its relevance as it relates to its surrounding built environment, as it relates to ESG, and as it relates to other uses if it's not being served in its current use. We made some big mistakes in the US and in many other countries with suburban sprawl, just going out further and further and further and further, and missing the opportunity for more dense neighborhoods, better walkability, easier transportation, mass transportation. And it's been a long journey to get there, but I do think, to Thomas's point, we're now watching the needs for ESG drive public funds, private funds, and philanthropic funds to come together to make big changes in a lot of cities. I think the Saudi Arabia example is probably the most magnanimous we know of in the world right now. But we've seen Milan remake itself with a technological city on the outskirts, and their old, I believe it was the World's Fair site. We've seen, I'm from Dallas, Texas. We've seen the private sector come together with the philanthropic sector and do some grand things in reimagining the Trinity River and building a park over interstates to connect the downtown to the uptown neighborhoods and make them more walkable. There are solutions that can work. London did one of the best jobs in the world with the 5 new railway villages, and then improving the rapid transit out all the way to Cambridge and up to Manchester and Birmingham. And now someone that's got a job in London can live with confidence in Birmingham or Manchester and get into the city when they want to. And that is appropriately rethinking our built environment.
Yeah, and that's a good point. It's real estate itself cannot solve the problem. It's including infrastructure, smart cities, big cities. We have this discussion, but we haven't seen so many solutions globally. But we have to focus on that. Yeah?
Yes.
And Pete, just picking up on that side, what's the situation here in Belgium? there's bound to be, you would sense, I mean, Brussels obviously a very big office area, particularly with the European Union, of course. So is this different in terms of office, or are you seeing the same kind of trends of work from home and the implications for the office sector here?
Yeah, definitely we see the same trends, and I would even say a little bit, how should I say it, even a little bit worse, because a lot of the European Union workers are still back at their home, so they didn't return fully back to London, to Brussels. Secondly, we have of course large administrative centres being built in the 90s, in the 2000s, where today we have to see that those buildings are completely obsolete. So next to the North Railway Station, we have an entire monotype office environment, with all buildings obsolete from an ESG point of view, but also obsolete from a occupier's point of view. The good thing is that a lot of landlords are seeing the situation very clearly, that there are new projects being built. All those projects are being mixed use. So we'll see a lot of hospitalities, residential, together with offices in those mono office quarters, which is a good thing.
Okay, good. I wanted to pick up briefly, just Thomas, in terms of, because there's been a lot of discussion around life sciences, data centers, a lot of those new kind of elements, and whether or not they're really an investment opportunity, or they're so niche that it's only going to be, small players who come in. Do you see that building? Do you see that appetite growing for that? And I'd be interested to get your perspective, Byron, on that as well, because obviously those are often more mature industries, again, in the US.
Yeah, I would start with the data center, and I think it was in our last year's report already one of the top 10, and there's much more need this year, and we see some continental Europe, some players that trying to focus on a European offering we haven't had in the past. So if we compare that to the North Americas or the Asia Pacs, they're much more focused REITs buying billions of data center. We don't have it. And with the upcoming, again, starting perhaps with Germany, where I come from, digitization is still a topic high on the agenda, but if it's still underdeveloped compared, not just the industry, it's also the country, and we have to rethink this digital infrastructure. And one component of that are the data centers, which are focused on infrastructure investors, from real estate investors, from operators, and there's definitely a significant need, and it will stay on the agenda for sure.
I mean, it's been interesting to watch, I think, because so last year we did a series of, for the first time, sort of infrastructure-focused events. And from the infrastructure side, the discussion around both new energy, renewable energy, but also the requirement for data, and therefore, from the real estate perspective, if you looked at it from that side, the growing demand that there will be for data centers was really noticeable, I think. Byron, sorry.
Well, I think in the context of growth, that whole alternative sector, we think of real estate historically as the four major food groups of office, industrial, retail, and multifamily. And then you add hospitality on, then you add healthcare real estate on. This new category of alternatives that includes data centers, life science centers, college housing, self-storage, solar farms, cell towers, wind farms. That alternative group is enjoying the fastest trajectory of investment interest in the allocation wheel. Even though the four main food groups still dominate the capital structure, that is a very fast growing area, and it only speaks to the needs we have in society, right?
Yeah, absolutely.
And so there's more capital going into that, or
Yes.
is it still? Yes, definitely.
Yes. Now in life sciences gets pulled out with data centers a lot as well. The life sciences industry is still concentrated in a few very important nodes. The Boston corridor, San Diego, Raleigh-Durham is trying very hard. London, Frankfurt, would you say?
Oh, a bit more Munich.
Munich,
More
okay.
Yeah.
And so the life sciences industry seems to be centered around places of intense science scholarship. And so it's not, a developer in any city in the world isn't going to go build a $900 a foot or more life sciences building, but it is a growing area for sure.
Yeah, it's been interesting to see that, and especially, that there are now growing, that people actively building centres in Glasgow, for example, Edinburgh, but also in London, Canary Wharf. We wouldn't have expected there to be life sciences moving into Canary Wharf. Yeah. So big change there, I think. There's a lot of discussion, Pete, about, so for example, I've been talking to Prologis, but also Garber, and a number of those logistics players are also therefore looking at data centres in the sense that it's another big box, just has something different in it. Do you see those in the same way? Do you see that there's a kind of crossover point here, or do you see them as very different types of investment, I suppose?
Yeah, we still see them as different investments, and more indeed for our infrastructure colleagues to have a look at them, because the dynamics are totally different. The locations are also totally different, and we also like to look at the second life of a building. So we're buying now in logistics, but we are thinking about second life or second users of our buildings, which for data centers is far more special and difficult than for straightforward big boxes. So for us it's more specialized for our infrastructure colleagues.
Okay, good. It would be interesting just to get in terms of your strategy, particularly looking at locations in Europe. Are there favoured locations? Are you looking at the UK? Are you looking at Southern Europe? Are you looking at Eastern Europe? Has there been, a kind of drop in interest in places like Poland because of the effect of the Ukraine war? Or I suppose, how are you seeing the sort of geography side?
We're still active all over Europe, so we haven't shied away from Central Eastern Europe. We are currently closing on a large portfolio, pan-European, 4 countries, including a country in the CEE region. So I think the CEE region still has very strong demographic growth figures, which will translate into a higher take-up and demand for logistics. So we're not shying away from any locations, from the Nordics until Portugal, and from France until Poland.
Okay, good. And Thomas obviously mentioned, and Byron at the beginning, the sort of changes in terms of, supply lines and those kinds of things. Are you seeing more nearshoring, those kinds of things? And is that part of, I suppose, your structural look at that particular sector?
Well, yeah, so we're still seeing the 2 big drivers for logistics take up these days. E-commerce still growing. We all know that for X billions of e-commerce that there is quite a straight line to the numbers of increase in take up. So that exists. We see indeed inshoring, but also people building up their stock after the big sales during Corona, so there is a piling up of stock. So those 2 big trends are still driving huge demand for take-up, and that combined with vacancy levels, which are basically all over Europe at 0%. They're at 1 or 2%, but that's including secondary and obsolete buildings. That's clearly pushing the logistics growth story. And the reason why we are seeing double-digit rental growth figures all over Europe, up to 40% in the UK, and that also for the coming years we're still predicting rent growth figures above inflation in Europe.
Okay, good. And Byron, is that because often, we've seen trends happening in the US and then they sort of come here, particularly I'm thinking of the e-commerce logistics trend. What's happening there? Are you seeing sort of the same kind of growth in terms of rental, or is it a different market there?
In terms of multifamily rental, or in terms of the
No,
logistics?
I mean the logistics.
In logistics, I think we're still seeing a broken supply chain that's improving. The Long Beach port still has ships waiting to come into port to unload. production of certain component parts has been slowed because of the absence of those parts, semiconductors getting the most of the headlines. And so that has pushed manufacturers to a greater desire for onshoring, this term no longer just-in-time manufacturing, but just in case. They want to have those components in storage. So that's probably driven people, what would you guess, 20% of the demand, with e-commerce taking the rest of the increased demand? The onshoring we're seeing as a driver just for folks to have the goods there that were not available to them when they saw the supply chain break down. Is that a pointed trend toward deglobalization? It could be. We're going to be researching those data points to see if we're watching 40 years of globalization begin to unravel a bit. But I think one of the defensive measures of the distribution and logistics industry is having more space available for those manufacturers and distributors that want to make sure they've got goods in stock so we don't have the disruption we just experienced over the last couple of years.
And I'd be interested to get your view as well. Obviously, talking to a number of investors here, most people divested out of Russia, after 2014 in any event. But obviously a lot of people still invested in China. Is there a view in the US, particularly because there's been negative kind of views on China for a while, is there a view that American capital is beginning to look uncomfortably at China in terms of investment in real estate, or is that a kind of separate part of the discussion?
Well, because of the Chinese land use laws and the lack of title insurance available to a foreign investor, I think that's never been a huge focus. The joint venture business has probably slowed dramatically for both COVID and geopolitical reasons in the last couple of years. My bigger concern is that we are creating a new era of Cold War between two different sets of ideologies that will ultimately affect the investment and capital flows between those countries. And that's my observation right now. I hope it's not happening, but it feels like it is.
And I don't know whether anybody's got a view. I mean, I know there's not somebody who's an Asia specialist here, but it would be interesting. Are we seeing any differences in terms of the capital flows from Asia into Europe or into the US and vice versa?
I think the capital flows are still significant, as we said in the studies. As Byron said, from a currency point of view and from the interest rate and hedging cost perspective, Europe is pretty interesting for North American investors as well as for Asian investors, definitely, because it's less a real estate play, it's more a currency play and a hedging play. And we have seen that in other cycles. And if you now, coming back to the real estate story, if you find the right opportunities, and there might be some reluctance to buy now, but definitely we are expecting a really active market by the end of the year. Yeah,
I think we're seeing Japanese, Korean, Middle Eastern very active, Singaporean very active. The Chinese have not been, and I don't see that money coming back anytime soon, except for the wealthy Chinese families that did get money out. Much of that's housed in London and Vancouver, and they are still investing. And the growth of ultra high net worth families around the world increasing their allocations to real estate around the world is also a growth factor in the capital space. And of course, we know that the Japanese have large uninvested pools of capital targeted toward real estate that is trickling into almost all the markets.
Okay, good. And there's no concern that that's going to be negatively influenced because we've obviously seen interest rate cycles going up, which mean bond rates will the comparison with real estate may adjust there. So is there concerns that some of that capital will simply move into bonds and move away from real estate?
Could, especially those that had the deep concerns over negative interest rates. I think that's a very fair question, and the bonds would offer a less risky alternative.
Okay, good. I wanted to pick up a little bit, just because it's interesting, Pete, here that there's quite a big focus, particularly in the listed sector here, and I'll be at EPRA tomorrow for the conference. particularly in the real estate side on healthcare, those kinds of things. You've got some big players here in the market. How do you see that sort of healthcare market? Because that seems to also be a growing one.
It is, and it's very a niche market for sure, and so it also requires special skills in-house, which I think today we have a less focus on. So I think that we will not be very active in that market going forward, just because we don't have the right skill set in-house to understand, like I told you in the beginning, the occupiers market and what the occupiers want. So we leave that to the specialist investments. Although that my indirect colleagues, of course, are invested in the healthcare business, but then indirectly through other partners.
And what's happening here in Belgium in terms of the residential side? I mean, we've seen across Europe a lack of residential, a demand for affordable housing, those kinds of things. Is that impacted as well by financing costs and those? Does that make it more difficult, because there's obviously a big focus on affordable housing, across both the investors but also from the demand side?
Well, Belgium is a little bit special on that equation, because we don't have really an institutional residential real estate market. So most of the apartments are privately owned and also rented out by richer families that typically owns 4 or 5 apartments. So there is no really institutional market here in Brussels, and that also has to do with the fact that developers always have been very easy to sell off piece by piece their apartments, and so didn't feel a need to go into let's say big portfolio deals or big entire buildings. We anticipated that would change. We have seen some institutional buys over the last 18 months. We also were active in that market, and we expect that to change even more, given that, as you said, debt availability also for private is going to be tricky the coming months. The rise of construction costs will make that the sales price need to go up, and that the affordability for buying a house is going to be very tricky for a lot of Belgian families. And so we expect that in the current market we have 60% which is still buying houses in Belgium and 40% only leasing out. So we expect that balance will shift to 50-50, and that the leasing market will pick up even further.
Perhaps one comment, Richard. We're doing an analysis in Europe and in Germany on the listed real estate, especially residential space. And I think the last analytics from, I think it was end of August, was that we see significant discounts for residential companies currently in Germany, at 50%. So that means so the market is expecting that the values, of course, they are always a bit older because they are only valued once a year or twice a year. But the current market says that the asset is only worth 50% of the listed value, and that's really significant. And usually, of course, we have premiums. Usually, it should be around 100. You get 100% of your asset value on the exchange. Sometimes it's a bit above. Sometimes we have discounts. But currently, we're facing a really strange situation where we all say, well, residential, there is a substantial need for residential, from the occupier side. But if you look at the listed entities on the average, you see that there's a significant discount, or the market expect that prices should be much lower than the values that are on the books. That was just a comment I learned from our monthly report.
Okay, good. I wanted to pick up on retail briefly. Obviously, sort of 5-6 years ago, we would be doing maybe 7 or 8 briefings just on the retail sector. That's dropped to retail warehousing as a focus, food retail. How do we see that? Do you think now values will have dropped to a point where retail will now begin to be on the up again. What's your sense of that? Will we be doing more events on retail in 2023, do you think?
Maybe not in 2023, but I think in 2024 for sure.
Okay.
Because what has surprised me over the last 12 months is how resilient basically retail has been, and how resilient also the tenant has been, and how big the take-up of retail space has been, especially in Belgium, where I know the market quite well. We have 2 big shopping centers, relatively new but not absolutely prime in let's say more difficult or challenging cities, and they're all almost fully leased out. We have had great take up, so that has stroked me quite a lot the last 12 months.
Okay, good. Byron, what's happening in the US there? Because obviously there was a decimation of retail.
Sure, I think the transformation is continuing. I think the bets on apparel coming back the way they were pre-pandemic are probably deeply handicapped. But when you look at the consumer spending, they are, with higher interest rates, bloating their credit cards again. They've not stopped spending. But from traditional expenditures, they've shifted to experiential expenditures, health, wellness, spa, beauty, outdoor activity related expenditures. And if you look at the occupiers taking vacant retail space, it's largely in the health, wellness, and beauty categories. And so I think we will see different users in the boxes. I don't think the high street, very expensive retail is going to bounce back quickly. And I think we're going to see the online retailers choose brick and mortar strategies to mirror their online strategies to deepen their omni-channel relationship with the consumers. So I'm not as bearish on retail as I was 2 years ago. And I think that we'll see that transformation continue. But our lifestyles have changed dramatically and will be that way for a long time. The belief that we can have a navy suit or a black suit and the rest be sweatpants and Lululemon seems to be the apparel choice for the short term.
You've been looking at my wardrobe.
But I think we are all buying golf clubs and face creams and taking advantage of experiential opportunities and visiting virtual reality studios that are in retail spaces and other experiential opportunities to connect with people, because we've not been, and retail is benefiting from those behavioral attributes.
And a big part of the take-up has also been, next to health and beauty, food and beverage, of course.
Yes, indeed.
So that's also a game changer, with people going to live smaller, eating more outhouse. So that has definitely helped the retail take-up.
Just one quick thing, Byron, as well for you. A lot of growth as well here. I mean, you mentioned student housing, but we're seeing a lot of growth here in Europe as well in terms of senior housing, especially. What's happening there in the US on that? Because I know that there was a lot more investment in senior housing earlier in the US as an asset class.
I think 3 things to consider. The increased housing prices to be able to sell, and this was mostly pre-interest rate rise, allowed mom and dad to finally sell that house and move somewhere, and in many cases that was to an independent living or age-restricted community closer to their children, but take the money out of that primary residence. That's number 1. Number 2, the age of entry into traditional assisted living went from 83 to 85 years old, so they're delaying going until they absolutely have to. And then there are growth areas in the niche aging industry around memory care and more independent living with limited services but not full nursing services that you see in assisted living and skilled nursing. So as we accommodate the needs of that aging population, and by the way, all of our Western world countries are experiencing growth in the aging population. They have unique housing needs, and we have a growing boomer, Z, millennial buying audience on the other end of the barbell that needs housing. So we need mom and dad and grandmom to sell those homes so that there are more to satisfy the demand for the other end of the barbell.
Okay, good. Well, I'm delighted to hear I've got a few more years yet before senior living. That's good. The longer that continues, the better. Does anybody have any questions that they want to ask, or any thoughts that they want to contribute?
A word on yields and interest rates. I'm old enough to remember when it was normal for yields to be considerably below interest rates and inflation, because we saw real estate as a defense, and you started with a low yield, but it went up. We've forgotten that. It's worth, it's not automatic, and it must be selected. Then I'd like to say a word on sustainability and growth. And when I look at the Café Leopold here, for instance, and look at, remember some of the buildings I was involved with in the 1970s that were then brand new, top of the spec office buildings that are being demolished and replaced by buildings that aren't really very much better. And they're not, certainly not any bigger, so you're not aiming by saying, well, we can build 50 stories instead of 6. And then looking at the carbon footprint of the old building that was, if you like, not amortized because the life expectancy is 50 years, not 30. And then the carbon footprint of new build, all that is enormous. To have some economy on the future running costs, but I think if we look really objectively at the carbon footprint of new for old, we're better to try and see, not in every case, but in many cases, how we could
Reuse.
improve what we've got rather than just knocking it down. And then the last remark I'd like to make is on logistics. Again, when I started work in the port of Antwerp in the 1970s, the normal height was 6 meters. Now logistics is very binary. If it's not exactly what the box that everybody is building, it's no good. That means when trends change, you've got to knock it down. And I think when I look into last mile logistics or cross-dock warehousing and so on, and then look not just at the square meters, but the cubic meters, the way we're handling goods is primitive. There's 2/3 of the volume is empty. The space is racks, but then you've got the aisles, you've got the sorting areas where you're just working at 1 meter. When you think of how shipping has changed, again, I can remember the port of Antwerp when the general cargo was being taken off by dockers and everything was moved bale by bale or sack by sack. Now it's all in a container. That's going to happen inside the logistics buildings. With artificial intelligence, you could put far more things into the same volume than we do now. So are we really going to need to keep increasing the logistics space we've got? I doubt it. But That's just a few thoughts from another.
I would just say I wholeheartedly agree that this next cycle is all about development and redevelopment as opposed to tearing down and starting over. And the ESG considerations of new build are, I've heard, exponentially as much as 8 or 10 times greater to build new than to redevelop old. And I think that's also eminently more financeable in this tightened banking environment. So I agree with you on that.
Yeah, the embodied carbon piece is much more on the agenda. In the past, we focused more on this operational carbon emission, but as you said, the embodied carbon must be more and more, and is on the agenda. But it's sometimes, if you have a project development planned with a demolition and reconstruction, then it's difficult to turn around. But I hear it more and more from the developers that and also the pressure that's coming from the outside, from the stakeholders saying, look, you don't have to destroy this building, you can still renovate it and have a proper use and a proper value increase. But still, on that piece, again, the CO2 price is still too low to have a proper, let's say, calculation on all the impact that has on CO2.
So is that regulation going to be driven by, cities just not giving permission, if you like, not allowing that to be done, or is it going to be EU regulation here driving it?
It's a mixture. It's the EU regulation, of course. The embodied carbon is more and more on the agenda. It's not the number one agenda point, but on the other hand, it should also be the CO2 price, which is a market mechanism.
And Pete, did you want to pick up any of the logistics points? I mean, I think it's interesting that idea of how innovation may change use of space, certainly.
For sure, and we see, of course, high bay, and we see the entire new concept of logistics that, for example, Amazon uses on multi-storage, high level of robotization. Having said that, we still believe that, coming back to the good old location point of view for real estate, we still believe that location will be a very important driver for logistics, and probably your 6-meter shed in the harbor of Antwerp will stand longer than a 12-meter high off-pitch logistics. So I think even those new concepts will still need the location close to the transportation hub, close to the big cities, and then with a quite a rectangle 12-meter high standard logistics building, I guess we will also be able to accommodate new ways of storage.
Well, I know we've just about come up to the end of our time, so I just wanted to wrap with a sort of final thought from everybody, really. I mean, I think it was interesting that point as well about how people used to perceive relative risk in terms of real estate and the pricing of it. So it will be interesting just to get everybody's kind of final thoughts on where we see things going, but also where we see the opportunities as well, I think. So let's maybe start with you, Pete, in terms of a sort of wrap up and where you're seeing the opportunities. I suspect it'll be logistics across EMEA, but you but you can give us your view on Belgium as well.
Well, no, I think wrapping it up with the risk of repeating myself, I think ESG is there. We have to be very careful. I think that assets are going, the life cycle of assets are going to become much more shorter. I think assets which were developed 5 years ago as top-notch ESG buildings today are already a little bit doubtful, referring again back to the Quartier Nord here in Brussels, where we see buildings only 15, 16 years old, which are basically today obsolete to accommodate the ESG demands from occupiers. So I think that's going to be a very big point of attention for us going forward. And the changing occupiers' needs, both in residential offices and like Jonathan said, also in logistics is going to be very important to be very close to your occupiers, understanding their needs. And we believe that if you get that question answered right, that you will see good opportunities, and that returns over the medium term will still be very appealing.
Okay, great. Byron?
Well, I think one thing we've not talked a lot about today is the impact of technology on the industry, and I think the real estate industry has historically been behind. When I look in the audience, I see two of my partners who have built in practice around data, digital, Internet of Things, geospatial analysis of where customers are located, where footprints ought to be, how you ought to grow your business around the world, improved management systems, improved energy management systems, interaction of buildings with everything from parking solutions to security solutions to maintenance solutions. All of that technology has taken a great leap forward over the last 2 to 3 years that frankly we've not seen in the last 20. And I think that's going to be a big part of how our industry matures, is the use of new technology.
Yeah, I think that's interesting. I mean, we did a session this year as well on advanced manufacturing for the first time, which, you know, if you'd have asked me 2 years ago, would I be doing something, a specific event focused on advanced manufacturing, I would have said, no, I don't even know what it is. So, good. Thomas?
Yeah, perhaps seeing the market sentiment, you could be very negative or very positive. So is the glass now half full or half empty? So I would say it's half full, and this market environment, which all of us haven't seen in this combination with all the triggers we've seen, brings a lot of opportunities. For me, it's the tech space. Yes, definitely. If it's a venture capital investment in the real estate and prop tech and context, or ESG related tech, is a big. But I see more and more investors see this as part of the real estate parameter to invest in. Of course, small amounts, but that's a big one. And the transformational piece, the good location around the globe, in the urban areas, in the close urban area, transforming these assets into energy efficient, ESG compliant, sustainable uses. That's something where I would focus, where I would bet my money on, combined with technology.
Great, thank you. Thank you, Pete. Thank you, Byron, and thank you, Thomas. We'll be writing this as an editorial piece for the Expo Real issue, so that will be the cover story at Expo Real. Thanks very much for your kind of views, really interesting there. And if you're watching this on demand, thank you very much for watching. Thanks very much, everybody.